Module Overview. What are financial statements? Financial statements are structured reports that quantitatively present the financial performance and position of a business or organization over a specified period. These statements are developed using standardized formats and accounting principles, allowing external and internal stakeholders to evaluate the financial strength, profitability, efficiency, and liquidity of an entity. Definition: financial statements are formal records of financial activities and position of a business, person, or other entity designed to present financial information clearly and systematically. The four primary financial statements. There are four foundational financial statements that form the basis of financial reporting. A. Income statement, profit and loss statement. Purpose: shows profitability over a period. Core elements: revenue, cost of goods sold, gross profit, operating expenses, net income. Example: question it. Answers: did the business make a profit this year? B. Balance sheet, statement of financial position. Purpose: captures a snapshot of financial condition at a point in time. Core elements: assets, liabilities, owner's equity. Key equation: assets, liabilities, equity, a text. Assets, untext liabilities, plus untext equity. C. Cash flow statement. Purpose: tracks cash inflows and outflows. Core sections: operating activities, investing activities, financing activities. Important for liquidity analysis and short-term survival. D. Statement of changes in equity. Purpose: explains movements in equity accounts. Includes share capital issued, dividends, retained earnings, reserves. Users of financial statements. Different stakeholders rely on financial statements for various reasons. User group use of financial statements. Investors assess profitability, evaluate ROI, make buy-hold decisions. Creditors, banks evaluate creditworthiness and debt servicing ability. Management monitor performance, guide internal decision-making. Employees evaluate company stability, wage potential, job security. Government regulators ensure tax compliance, monitor regulatory adherence. Auditors review for accuracy, completeness, and fair presentation. Basic principles of financial reporting. Understanding financial statements also requires a grasp of the underlying principles and assumptions in financial reporting. A. Accrual principle. Revenues and expenses are recognized when earned or incurred, not when cash is received or paid. B. Going concern assumption. The business is assumed to operate indefinitely unless there is evidence otherwise. C. Consistency principle. Accounting methods must be applied consistently across periods to allow comparability. D. Conservatism. In the face of uncertainty, record the least optimistic estimate, e.g., anticipate losses but not gains. E. Materiality. Financial statements should include all relevant data that could influence decisions. How financial statements interrelate. These four statements are not independent, they are interlinked. The net income from the income statement affects retained earnings on the balance sheet. The ending cash balance on the cash flow statement matches the cash asset on the balance sheet. Changes in equity captured in the statement of changes in equity flow directly into the balance sheet's equity section. Example: if a company earns N2,000 profit, it appears as net income on the income statement. It increases retained earnings on the balance sheet. It is part of operating cash flow if received in cash. Why financial statements matter. Financial statements are central to A. Performance monitoring. Executives and managers use them to track progress, identify weaknesses, and adjust operations. B. Strategic planning. They help in budgeting, forecasting, and strategic decision-making. C. Investor relations. Public companies are required to publish audited financial statements to attract or retain shareholders. D. Financial health assessment. Liquidity. Can the company pay its short-term obligations? Solvency. Can it survive in the long term? Profitability. Is it generating enough returns? E. Corporate governance. Transparent financial reporting promotes accountability and trust in management. Illustrative example. Let's assume ABC Limited is a retail business. For the year ended December 31st, 2024. Revenue N50,000. COGS N20,000. Operating expenses N10,000. Interest and taxes N5,000. Net income N15,000. This means gross profit N30,000. Operating profit N20,000. Net profit add N15,000. ABC Limited shows profitability. Now this net profit will increase its retained earnings, be reflected in cash flows if paid received, enhance equity position. Summary of key takeaways. Financial statements are the language of business. There are 4 core financial statements, each with a specific purpose. They are used by a wide variety of stakeholders for decision making. Understanding the principles behind them enhances interpretation accuracy. Proper analysis reveals insights that raw numbers alone cannot show.